Hey everyone, it's Ed Kime over at Quantcha, and welcome back to another day of the Quantcha Challenge. As always, we invite you to check out our unlimited commission-free stock and options offer for just $99 a month, where you get not only commission-free trading, but also full access to the Quantcha Options Suite. So, without further ado, let's dig into the portfolio and where we stand today. We'll do a quick review of our positions. I'm going to hold off on talking about the trade we opened yesterday, the earnings trade into Grainger. We'll just take a quick look. Notice that we're bullish on Carnival, and we see it's been moving upward. That's kind of nice. It's going to take us a little time, I think, before we start to kick in some profit, since we still have over 3 weeks left on the trade, and the liquidity is not great with the options. But we're going in the right direction there. We lost a bit of ground on Microsoft today. Now, granted, this is something that we plan to close tomorrow, which is the Friday when these options expire, or at least are settled in one way or another. This is still okay. I mean, we're still up on the trade. We're in good shape. And as long as we don't see a big drop tomorrow, I'm pretty happy with this. Even if it spikes up, I don't mind getting it assigned away. We'll talk about Exxon's been kind of up and down today, but mostly down. We are bearish on it, so this is going in the direction we want. We are expiring at the end of next week, so we would like to see it get closer to 71. It did actually breach through 71 earlier today and get below it, but it's sort of recovered and been just sort of hovering around a break-even day. This is on our side, though. Most of these trades have positive thetas, so we are at the point where we should hopefully gain some ground as time goes on. I don't know what really to say about Micron. Somebody at their headquarters found the Holy Grail this morning, I'm guessing. So they were up almost like 10% earlier today. There's no real news or anything. The semiconductors in general, so hardware's having a good day. Micron, Nvidia, some of the other guys, they're all moving up. Which is fine. I mean, we're in this for another 3.5 weeks, so we'll kind of hang out, wait and see what happens. In the event that we get a couple stronger down days, I think they'll get hit a bit harder. I mean, you'll notice we are down on the market today by a little bit, and this is up super strong. So right now, if we were to close it at market pricing, we'd end up losing more than our investment. It would cost us money to. It would cost us a lot based on liquidity. But at this point, there's really no point. We'll just kind of let it ride because it's already fully accounted for in our portfolio as a loss. So yeah, I mean, we'll just see where it goes, and it does give us some nice negative delta, so that we can even out our book. We're a little positive right now. That's largely due to our Microsoft position, but at the same time, it's single digits, so I can live with that. So that being set aside with the portfolio review, let's go ahead and return and talk a bit about the trade we had set up yesterday. We set up a calendar strangle trade to trade the earnings of Grainger. This was a stock that is reported earnings this morning, and when we saw it yesterday, the main thing that caught my eye, we found it from the screener, and from the screener we were looking for an earnings trade. We were looking for something with a high earnings crush, or rather a low earnings crush rate, indicating that there was a lot of value in the options that was expected to be crushed out when earnings hit. And at the time when we took a look at it, and I apologize in advance for the poor quality of these screenshots, but they're actually screenshots from the YouTube video from yesterday. Definitely recommend, please go check that out. That is the from the January 23rd Quantcha Challenge video. But the weekly options were at 140 volatility. That's those ones, the first ones over here in the this first category. And those are the ones that are expiring tomorrow. And then the next ones out were at 75%. And the reason I call those out is because there's a substantial difference there. Obviously, the ones closest to expiration being the highest is no surprise. But the crush rate indicated at the time, if we move forward to the next part of this, that so the volatility is about 140. The crush rate was 47% or so, which meant that the post-earnings volatility for the weeklies were expected to be at 62%. At the same time, if you look at the long-term implied volatility, and this goes out further because they have more options, that averaged about 39%. And so what that sort of tells you is that even though this is a bit inflated, it's more the ballpark where you expect the options to sort of settle in at once the earnings is cleared up. And the fact that there's such a huge disparity, we call this earnings Ivy richness, which is saying that the pricing of these options here, based on the options around them, are so expensive that they're about, you know, 230 basis points richer than just a reversion to the long-term volatility mean. Now, we know that after earnings, this number is going to go down anyway, because even the longest term options are still a bit impacted by the earnings call, but we know that it's going to be generally in that ballpark. So what we did was we set up a calendar straddle. That meant that we sold a straddle for the first week, for the front week here, and this was just an at the money call and put we sold. And then we did the same thing where we bought an at the money call and put for the week after. And the purpose of that was to try to isolate volatility. We didn't want to be too dependent on delta or gamma. I mean, obviously, in any kind of trade, there's going to be risk somewhere. And so what we sort of wanted was we wanted to have the risk be further out, saying if there was a really, really outsized movement one way or the other, that we would lose money. And this looks fairly similar to what you might see from a butterfly or a condor trade, except that it would take a ton at this point to lose all the value. I mean, if you look at this, I mean, this is a plus or minus 15% movement that we have in our profitable range, that plus or minus one vol, which meant that the stock, this Fortune 500 company, would have to drop more than 15% or rise more than 15% in order for us to start losing money. And even then, it's fairly gradual. And this is just a reference chart. We weren't planning on holding it until this particular expiration, but the idea was we knew that both of these expirations were going to drop in their volatility. We knew that was going to happen, but the bet we were making here was to say, I guess the best way to put it is that we believed that the drop in here was going to significantly outpace the drop here, and we'd be able to profit on it. So let's take a look at that, and there's a couple numbers to keep in mind. The first one is we were at 140. The crush rate said the pricing was going to be was being priced at 62%, but the long-term rate was at 39%. So what I'm going to do is I'm going to go over and take a look at where we are today, and we could see 39% is where this settled in at. This is the current options for tomorrow. That's the at-the-money volatility. I mean, that's just really, really close to what we had been looking at and what we were expecting. And so, I mean, yeah, so we were pretty right there in that it really did revert towards that long-term volatility, and that the option pricing was way too rich. And we had a drop here too. Now this drops to 33%. Now prior it had been 75%. So it's a little more than half that it lost, but it's not quite as much as this one, which lost, I mean, that lost what, 60, 70% of the volatility it had been holding on to, maybe even a little bit more. So net, we should have been able to profit today if we got up and we didn't see a huge move in the stock itself. Now, as you'll see, the stock it was down 4%. Not great if you hold it. Obviously, if you're holding the stock, you're going to get a bit of a loss there. But as far as our position goes, that should give us an opportunity to turn some profit. Now, this is the downside to the issue that we face when we trade positions like this. One of the reasons we went with this particular stock was that its liquidity rating was good. We have a scale of 5, which goes from 1 to 5, where 4 is a good rating in liquidity, 5 is great, and of course 1 means there's virtually no liquidity. That means, like, you know, we often don't have bids and asks for at-the-money options at the 30-day mark or so. So the good liquidity means that, you know, you expect to see weekly options, probably leaps. You expect to see, you know, some good liquid options around the 30-day mark. And we have a whole video explaining how the liquidity works into play. But one of the things that we've kind of taken a bug on internally, and we're going to work on fixing, is that number is a snapshot in time. Whereas if you see today, the option liquidity has dropped to poor, which is our number 2 out of the 5. Which means that the spreads are huge. And so here's an example. We'll take a look at the options for this. If I come over to the option chain to just show you, we were going to have to unload the 297s, which in this case, you know, 10 to 60 cents. Again, that's not too bad. But the puts, which are going to be much deeper in the money, that's going to give you a much more significant spread. You see this 10.20 to 13.10. This is not liquid. In fact, if you look at the chart to see what is liquid, pretty much we don't identify anything here as being liquid. And it's just as bad if we look at the following week. it's nothing's liquid. So long story short, I didn't want to sit here in the video while people are watching and show you step by step the painful process of exiting this position for a profit. So I'll kind of just give you the rundown of what I did. If we go to our orders for the day, you can see I started off here. I was optimistic and I said, let me try to close this calendar spread by just exiting all the positions at once in one order. And the downside to that is that that's a trade that you're going to go through, and it's going to have to be filled by one market maker. This ends up in the complex order book, which means that one party generally will sit down and they'll fill the entire thing, and they'll usually try to fill it by taking other orders where they can find that other people are looking for trading, and try to break apart your complex order and then make money on the spread with these other individual orders. But this isn't really traded heavily enough. The liquidity is not there for this to be likely. So at the time, the midpoint for this was going to fill at like $3, and the market pricing, if I just wanted to close it immediately, I was going to have to pay $1 to close this trade. So you can tell that the debit credit was pretty terrible. So I tried to break it apart into the call and put legs. And again, I started walking it in, and I realized it was pretty hopeless because they were only offering at midpoint like $1.10 or $1.20. I really wanted to see if we could double our money on this trade. So I finally took a bit of a risk, which I don't really recommend, but this morning the options weren't too bad, and I'm sorry, the stock wasn't too volatile. It kind of dropped it open and it just sort of hovered where it's at. So I went through the process one by one. I took the most vulnerable position we had, which was the short put for the week, closed it out. And you'll notice here, so I started off at around $11 and I walked it up every 10 cents. And I don't know exactly what happened here, but when we hit 11.50, it actually filled for us at 11.08. So, this is just a good example of getting a nice fill. I know there's always been concerns about the ability to close orders and get stuff in place, but I was pretty satisfied to be able to get a better deal on this than I had anticipated. And then so we closed that, and then I went and closed the put for this week as well. These two were deep in the money, so they needed to get closed out first. I was less worried about the impact on the call side of things, and I also didn't want to hold. I didn't want to hold the options because we have a very little window for difference. When you have a trade like this, and I will bring up the chart again. When you have a trade like this, you'll notice the swoops that come down here. What you're basically looking at to profit on this trade is that you're going to be you're short a put and short a call, you're long a call, long a put. So these guys are married because they're at their same strike, which means that in the event that you get a big movement, let's take the puts, right? We have this big drop, which means that the puts are both going to increase in value significantly and the calls are going to decrease significantly. But the good news is, because we're long the longer dated ones, our put and call in their fair market value will always be higher than the put and call for those on the short side. That's just the nature of it. I mean, you have more time to make a decision, therefore that time's worth something. However, the downside, the place where you can lose money on this trade is that, let's say we dropped all the way down here, we're in the 225 range. Well, what ends up happening is the time value between this week and next week becomes so insignificant that the puts that we're holding for long will have very little profit over the puts we're short. And while they might turn a profit, it'll probably be insignificant, and it might even get caught up in liquidity, as it would have here. And at the same time, the calls are going to be approaching worthless, both sides, because of the fact that it's so far away from the money and there's no big events coming that might cause a surge. So what you're really hoping for here is, when you open the trade, you know that you're going to have a little extra value. It's going to cost you money to open the trade, and your goal is, when you exit, that the increased value of your long positions will exceed the value of the amount you cost to open it. I know it's a long way to go about saying, hey, you want to sell it for more than you bought it for, but it's a very subtle thing here, because it's not really a directional play, because we're going to be lockstep dollar for dollar. It's much more about the decrease in time value of the short options versus the decrease in time value for the long options. So without further ado, let me just step over to the let's take a look at performance, and we will locate we're going to take a look at just the options we were looking at. Sorry, there we go. down here. We're only going to take a look at Graingers. And we've got this one trade we had. And if we take a look at the actual execution process here, like we opened it yesterday, these were the prices we paid, and we can see sort of one to one, like when we closed out this trade, like the put we had to buy back. We had to buy this back at 1100, but we were able to sell the put we were long for this much. So we made money on both legs, which is not surprising. And then overall, we were able to return 437, which was more than we basically doubled our investment, a little bit more, which is great to have on a one-day trade, which had relatively low risk. This trade was never going to bottom out at zero as long as we closed it before. Well, actually, it was never going to bottom out at zero as long as we didn't waste any time value, and as long as we kept the closing of the hedges as close together as possible. What a lot of people might try to do is you might see the stock drops today, so you would buy back your short put and then keep the long put on for the event that the stock keeps going down. You can make money on that, and that's okay if you have if you're convinced of a bearish position. But in our case, we were purely trading the volatility. We made the bet that the short-term vol was going to drop more significantly than the longer term, the second week vol. In this case, resulting in a greater decrease in the short-term time value versus the long-term time value. And that's what happened here. And I don't know that it would necessarily happen again for all kinds of trades, but at any point you can come into our screeners, check out the stock screener, and if I reset this here, for example, if we wanted to do this today, we would say 0 and 1 trading day. So just basically who's reporting before tomorrow. I would definitely recommend going for good or great liquidity. And if you're going to trade these, you can trade monthlies. Western Digital is the option here. It's the only one that fits all the checks all the boxes right now. But I would also recommend requiring the weekly options, just so that you're not putting a bunch of time value towards the long-term trade. Again, we've got that. This is the one option we have, so we'll kind of work with it. We'll take a look at where things are right now. The volatility here, it's got 158 for tomorrow. 88 for the next day or for the next week. If we slide down here, we can find out information. We got the crush rate is at 55%, which means that it's anticipated to retain 55% of its current volatility at 87. The long-term mean's at 51, so we're looking at what is really another pretty substantial. I mean, this one even appears to be richer than what we had with the options for Grainger. I would definitely consider this trade. The one thing that's on my mind though is that it's up 7% today. That just makes me not really trust it. I don't follow the stock. I don't really know it too well, so I'm not gonna get involved with it today. But I want to just point it out that that's how you do it. Setting up the calendar trade, you could go into the book manager and do it manually. Just as a quick review of how we did it yesterday. I selected the expiration we were looking at, which is the one that's 2 days out, or you could pull one from here from the drop down. But I recommend the first one following earnings. I went to the option chain. I went to look for the closest at the money straddle. So you'll see we've got greens in the money, reds out of the money. It's trading at 40.26, so you got to pick a side here. Let's just say 40.50. And I went to the short straddle trade. Now, don't worry too much about the warnings because we're not actually going to open this as a naked trade. But you can throw it at your book by selecting from model and book. You pick whether you want it to go into your paper book or if you want it to go into your brokerage account book. Again, this is just for modeling purposes. None of this stuff is a trade ticket yet, but we just see that this is there. I then use the back button as a shortcut just to return to the trade we were looking at, because in the trade analysis, it's really easy to switch between different expirations. So at this point, I'm going to go to next week's options. And it's going to find that exact trade using next week's options, giving me the same thing. However, we don't want the short calendar, we want the long one, which is just inverting our position. So we can click invert this strategy. Now we're looking at a long straddle. And then if I send this to the book, it's going to combine with the other position we added earlier, the other trade, and it's going to give us that calendar straddle. Now this actually doesn't really look too bad. Come to think of it, the projection is that it's likely to be profitable and the mean return is likely. However, and this is a big however, keep in mind that all this modeling is based on long-term movement of the stock based on a volatility and just sort of like effectively random motion and the likelihood of different amounts of move based on the past movement or whatever the options are laying out with the implied volatility. This doesn't really apply too well when you're thinking about binary events like earnings. A good example here is, yeah, there's a ton of profit you could make if you hit the nail on the head with this exact 40-50 strike price. But what are the odds that this stock's going to announce earnings and then not move in either direction? I mean, a 0% move is virtually impossible, although it's one of the highest likelihoods if you look at it statistically here. So again, that's just something to keep in mind. If this were not up 7% today or 6.5%, I might consider getting into it, especially because you do have a pretty good amount of potential here. I mean, there is the stock would have to move again 16% up, 11% down in order for you to not break even on it, and to open the position it'd be $83. So it's $83 with a mean return at this point at 77. So this is a good numbers trade. I just don't like this, and so I'm gonna punt on this today. We got a lot of earnings coming up, so I think we'll probably play this again, but just not this one. But feel free to play at home if you find that interesting. Anyway, back to portfolio. We're not going to make any changes today. We're not going to hedge anything. I had a couple questions come up that were pretty interesting around the beta weighting and some of the stuff we have. People are noticing our correlated return stuff. We are going to talk about that maybe tomorrow or maybe next week. But if you have other feedback, definitely let me know. Either leave a comment on the video or hit us up at hello@quantcha.com. And as always, good luck and good hunting.